Okay, let's go ahead and get officially started. So, I'd like to welcome you to today's webinar. Today's webinar is titled Three Strategies to Protect and Grow Your Retirement Nest Egg. And my promise here to you today is that when we're done here, you are going to know that you can retire with a peace of mind knowing that you can steadily grow your portfolio, that you can generate a safe and steady income, and most importantly, in my opinion, that you can preserve your net worth, your capital, your retirement nest egg, however you want to phrase it. That's what we're going to talk about today, building and managing your retirement portfolio. Whether you're at retirement, nearing retirement, if you're out there, and I wish I had a bunch of them out here and you're 25 or 30 years old planning for retirement, all of this stuff is pertinent to what you're going to need and want to do. So that's my goal. Before we get started, I'd just like to uh, ask you to turn off any and all distractions. Try to stay focused. I know it's hard. You can't shut your cell phone off these days. I know that, but maybe put it on vibrate, close your door, close any other windows on your computer. And I think we've got some good information for you here tonight. So let me start by introducing myself. I do see some familiar names in the chat box. My name's Jim Penna. I'm the manager of retirement services here at VectorVest. I've been with VectorVest now for 14 years, and it's been a great run. I love it here. I came down from Connecticut to North Carolina about, I don't know, maybe 16 years ago, and found VectorVest in a prior to coming to VectorVest. I took my Series 7 in 1992, worked on some small trading desks, ended up as a market maker for a larger uh, firm, Knight Capital, in the New York area, and then just decided I was going to bring my family down to some warmer weather. I got tired of shoveling snow. So I ended up here at VectorVest, and I've been loving it ever since. Now, just let me tell you, in two prior lives, if at any point during this webcast it sounds like I'm telling you what to do, it's because I was also a police officer back in Connecticut for almost 10 years, two lifetimes ago. So that's my story, and I'm sticking to it. Now, here's where it all begins. When we talk about building and managing our retirement portfolio, found this quote a long time ago, and it's been the core of what I think the message to convey here. And it is from Mark Twain, who said, "Don't just sit there and worry. Be proactive. Do something, anything about what's worrying you, so you can gain information, focus, and control over the situation." And ever since I've read that, I just, it's exactly what building and managing your money is all about. You can't sit there. You have to know what to do. You have to have a process, a system that you can follow. Right? And he goes on to say, "I've suffered a great many catastrophes in my life. Most of them never happened." Right? So there's all these things that can go wrong that we worry about that don't have to when you're properly excuse me, prepared. Okay. So that's kind of the basis of where we're working from. Now, when we started putting our webcasts and seminars and our educational information together, I remember a long time ago having a conversation with Dr. Bart DeLito, our founder and mentor, and I came to him and I said, all the people I talk to, whether it's via email or when we used to go on the road for our seminars, everyone I talked to in some form or fashion, the question came back: how do I keep from running out of money in retirement? And so, having this conversation with Dr. D, I posed that question to him, and answering me in only the way he can, he just kind of looked at me and said, "Well, James, just tell him to keep making more money." And that's kind of the genesis of what we're going to talk about in this process and there's in this system of how you continue to make money in retirement. Now, we believe that a secure retirement is one in which you have enough income to live the life you desire. And that's a key point there. The life you desire. Now, the cliche of, buying the boat and sailing around the world is great. These folks, you can see they did it using VectorVest. They actually named their boat the VectorVest. So that's a comedic pause there. Anyway, that we want you to be able to have the freedom to live the life you desire. That's what we define a secure retirement as, where work is optional and retirement is affordable. Okay. Now, to get to that peace of mind, we have several steps or several strategies that we want to focus on. We call them the three P's. Number one is profit. Secondly, we talk about provide and then preserve. Let's start with profit. What does that mean? Well, really, it just means buying good quality stocks in a retirement growth portfolio so that your portfolio doesn't turn into that roller coaster ride that has you suffering catastrophes that you don't have to be quite honest. Right now, I understand. I've been doing this long enough to know that no portfolio, no stock chart or equity curve on a portfolio goes straight up. There's always going to be some drawdown and some volatile times. But what we want to be able to mitigate is that really rough ride in times of uncertainty in the market. It comes with buying the right stocks at the right time. So we want to take it from a roller coaster ride on the capital appreciation side and turn it into a steady climb. Okay. Next is the provide side. When we talk about provide, we're talking about generating a steady income. Right? Yeah, everyone, if you own stocks, some of them may pay a dividend. You'll have that kind of trickle in or trickle down theory where, you're getting a few bucks from a couple of dividend paying stocks. But again, that's not good enough. What we're looking to do is take that trickle of income and turn it into a safe, steady cash flow. And then finally, in preserve, again, I'll say it 5 more times before I'm done here tonight, that preserving your capital, preserving your net worth is first and foremost, or should be first and foremost, on your mind. So we want you to go from being unprepared, not knowing what to do in times of uncertainty, to being prepared, to know how to stand up and say, no, I'm not going to give 50% back because of some condition in the market. I'm not just going to sit back and let that happen. I'm going to be prepared. Okay, so this really encompasses the three strategies in my goal tonight. What I'd like to do next is ask you a quick question in just a few words. Type in the chat box because I want to make sure everybody knows where the chat box is. I'm going to interact with you a few times throughout the presentation, and I want you to be involved here. So in just a couple of words, if you can answer, what's the hardest part about either preparing for retirement or if you're already retired? What are some of the obstacles that you see right now? I'm going to pause for just a second while you guys type in. All right, great. And yeah, some folks, here they come. Yep, Maria says focus. Yeah, it's hard to focus, right? And again, unless you have a process or a system, it's difficult to have a not have a plan, I should say, and be able to do this. Um, Michael says being consistent with the ups and downs of the market. Yep, like I said, you have to have a plan there. Brian says, I don't know how much money I'll need. And there's a lot of ways to do calculations. There was a time where we would talk more about that, but it's hard because there's a lot of folks in the chat room. Everybody has a different situation, but there are ways to calculate that. What we focus on is the part of your retirement nest egg dedicated to the equity markets and to teach you how to build and more importantly manage that. Okay. Dan says reducing risk. Yep, we're going to talk about that for sure. Ernie is talking about learning the VectorVest system. James says political risk. Yeah, that's always there, James. Like I said, nothing is ever gonna go straight up. There's always going to be headlines, and they're going to drive the market. But we can protect a bit against that again by having a good process. Michael says what stocks to buy. Um, Gordon says maintaining good health. Well, Gordon, I can do a lot of things. I like to think anyway, but that's the best I can do from this chair is help help your emotional health by helping you build and manage your retirement portfolio. The physical health. There was a time where I used to play a little ball, but not anymore. Um, KGG has a good one. Not overanalyze. Right. Sometimes folks will get too analytical and overthink some things. I like that. I don't see that one come in often when we do these, uh, but a bunch are coming in. I can't go through every one of them, but there's some um, very good answers there. And from what I'm reading, what I like to think is that you guys are in the right spot here today because a lot of these things I am going to talk about And again, I didn't mention I'm joined by my friend and colleague, Mr. John Marabo, who's be in the background helping to answer questions. I'm going to do my best to get through the presentation, take any and all questions at the end, but I have a bad habit of kind of trying to multitask. So if you hear me pause, it's simply because I see something come up in the chat box that I want to comment on. John will answer questions and then we'll both handle questions at the end. Sorry, I should have said that earlier on. Okay, well, let's jump into this. So, as the title of the presentation implies, there are three core strategies that we think every investor needs, retirement investment minded investor needs to know. That's capital appreciation, generating a safe, steady income, and capital preservation. Right, and I like to use this time to share a quote from the great hedge fund manager Ray Dalio. I'm sure most of you have heard of him. I paraphrase a little bit, but he said, you can't make money in the markets without taking some type of risk, and you certainly can't keep the money you make without being defensive. Okay, so that's what capital preservation is going to be all about. Right? You could build a portfolio all you want. If we're not capable of protecting, preserving, and knowing what to do to to guard that, then these two core strategies kind of get lost in the wind. Anyway, let's start with capital appreciation. This is where we're going to begin. Remember, that was the profit side of our little pyramid that we had going. We said that capital appreciation comes from owning companies with consistent and predictable financial performance. Consistent and predictable. I always ask what two better adjectives to describe the type of stock residing in your retirement portfolio. Right? Consistent and predictable. I mentioned I played a little ball. I played some baseball in college, and so I'm apt to use a lot of baseball or other sport analogies. And this one comes from a quote from Dr. DeLito, and he's written and said many times, good portfolio management starts with buying the right stocks. And I always, use that idea in my mind as you have to look at it as you're the manager or the general manager of a team. Right? You want to build a winning team, then you go out and you find the best players. Right? You create a roster of players that are going to go out and win, much like my favorite team, the 1969 World Series New York Mets. If there's anyone either from Chicago or Oakland, and I'm generating any bad memories, I apologize, but when it's the same idea as building a portfolio. When you have Tom Seaver out on the mound, Nolan Ryan was on this team, Tug McGraw, Cleon Jones. You have a good. I know none of you guys know who these players are, but when you have the right stocks in your portfolio, it's like fielding a really good team, a championship team, and that's the idea I want you to have. Jerry Kuzman, there you go. See, Thomas knows. Jerry Kuzman's in here somewhere. I could pick him out, but I'm going to keep moving. So when we're building that team or that roster of stocks, right, for our portfolio, we believe it all begins with safety first. In other words, for our retirement account, primarily our growth portfolio, you want to look at companies that are safe more than anything else. Okay. So while it's fun to hit the home run sometimes, to continue the baseball analogy, we all know what most home run hitters do when they don't hit a home run. Right? We all know what they do. Can anybody tell me what happens when they don't? And Maria, you're right. That was the best year. 86 was pretty good, but 69 was the best year. Yeah, Thomas and Murray and Paul. Yeah, well, they strike out, right? They strike out. And we don't want to do that in our retirement portfolio. So to avoid that, we have what we call our safety checklist, stock safety checklist. Okay, these are important factors that go into a proprietary fundamental indicator in the VectorVest program that Dr. DeLito put together the formula for. I like to take some time and talk about the pieces of the puzzle that go into that, so that I don't want to just say, hey, RS, what we call relative safety, is this on a 0 to 2 scale and just pick the highest point. I want to take a minute or two and explain what goes into that so that it's not just some random number that we're coming up with. So earnings consistency is one of the important part, maybe the most important part. Nothing more important than a company being able to grow their earnings quarter over quarter, year over year. right? It's that consistent and predictable performance. We say that company size plays an important part, but the key here is that don't be confused by just the fact that a company is a large company doesn't necessarily mean it's a safe company. Okay, so the company size it does play a part in the ultimate analysis of relative safety in the VectorVest program. Dr. Delito talked about price behavior being important. Of course, we want a smooth price pattern. Again, I'll say it again, nothing goes straight up, but we want a price pattern. We want to be able to have a formula that tells us, okay, maybe the stock is way too far above its mean, maybe it's way too below the mean average of the price of the stock. A lot of factors that go into it. Okay, but price behavior it plays a big part in the safety of a stock. Business longevity. Dr. Delito talks about companies. It's better to know the devil, better the devil you know than you don't know. Right? Doesn't mean companies who have been around for a shorter time can't be good, successful companies. But we're talking about safe stocks in our retirement portfolio, and business longevity plays a part. Dividend history. Now, it's important to understand a safe stock doesn't necessarily have to pay a dividend. But if it does, it darn well better continue to pay that dividend, hopefully grow it year over year. Because as Dr. D wrote, there's no worse black eye for a company than to have to suspend or cut or eliminate their dividend. It reflects poorly on management and on the future of the company. And then finally, debt to equity ratio. Just simply, what is we want to be sure it's favorable. A strong balance sheet lets us know that a company has the ability to withstand any kind of headwinds the economy or any other issues uh, bring towards it. Right? They have to be able to report positive earnings after any type of interest payment and taxes that they pay, if they pay. Right? So a favorable debt to equity ratio. So when you hear me talk about relative safety for the rest of the presentation, understand that there's a lot that goes into that. Okay. Now you can go find that data on your own, or try to. It's very frustrating and very cumbersome. So what we've done here at VectorVest, what Dr. Delito did, was create an indicator called relative safety. It's an indicator of risk. And as I said, consistency and predictability of financial performance are the primary factors that he used to create that formula. We put them as all of our proprietary indicators in the VectorVest program on a 0 to 2 scale. This is just a basic look. Anything from 1.1 to 2 is anywhere from good to excellent, and below that we have to be a little more careful. Somebody typed in, I think, I saw a question go by when I asked what's the hardest part. Somebody put in, I think, finding good stocks or finding the right stocks. So what I have here is a screenshot. This was from earlier today. I took the screenshot, and it happens to come from a search in our program called Ruler Stocks. There are in our search directory called the Unisearch tool. And this is not the only search that finds good quality stocks. It happens to be my favorite, so it's the one I use as an example. And very quickly you can see, just to make the list, this search engine that we have that allows us to find good quality stocks. Actually, it allows us to find crummy stocks too if you want to short stocks, or it allows us to find a lot of different types of stocks. But in this case, we're looking for safe stocks. So what are the parameters? How does a stock even make this list? Well, first of all, it's got to have an earnings growth rate, and this is in percent per year, of at least 14%. And the relative safety number, just to make the list, has to be at least 1.4, which is excellent on that scale that we use. And then to take it even further, we sort these stocks, right? They're sorted by the relative safety times the earnings growth rate. Right? That's the number you see here. That's how they're sorted. So it's a great search, again, among others, that allows us to find really good quality stocks. Now, you'll see on our spreadsheet here that under the relative safety header, we have, again, they have to be at least 1.4, which is excellent. It's very high on our scale, and it turns out these are the safest stocks in the database. The other great thing about relative safety, and I'm not going to go into all of the proprietary indicators here tonight. I just don't have the time. I've got other things I want to talk about. But What one thing to understand about relative safety is that all of the other numbers that we really care about, generally speaking, not always, there are always some exceptions, but generally all the other numbers that we care about will fall into place. One being relative value, which in the VectorVest program is capital appreciation potential or price appreciation potential. We compare it to a safer AAA corporate bond investment. Anything above one is favorable, and you can see very high, very excellent, very good, or excellent numbers. Again, with a couple of exceptions, there always will be. In this case, just one really in the top 20 here. Comfort index. Remember I talked about price behavior, that nice smooth behavior. The higher the comfort index, the better the price growth persistence, as we call it. Earnings growth rate is very strong here on this list. Again, I just took the screenshot earlier today. Many of these ruler stocks or high RS stocks, many of them don't pay a dividend. Okay, but the ones who do usually have a and dividend safety, DS, I'll talk about that in a minute, is the one indicator that is not on a 0 to 2 scale, 0 to 99, and you can see all very high numbers here as well. So that's just an illustration of the power of relative safety, how all of the other numbers in our stock analysis process fall into place. Again, not always, but certainly in a search like ruler stocks. Okay. All right. Oh, let me go back. So this is actually the last stock on the top 20. I just took the top 20 out today. And when we sort it by RS times growth rate, you'll see it comes in last. But it is the highest ranked relative safety stock. Right? It has the higher RS out of these top 20 stocks. Not that 148 is going to make a difference to 146. I mean, they're all very good. 147, you see great numbers here. But I like the stock, actually own the stock, so I wanted to use it as an example. So what I did is just pulled a graph slide of the stock. As of this morning, the RS, or relative safety, of West Pharmaceuticals was at 1.48 on 11/11. By the way, if there are any veterans in the room, I salute you on Veterans Day. Thank you. And if there's any Marines, yesterday was the Marine Corps birthday, so I forwarded that message yesterday in a webcast as well. Anyway, so 1.48 as of today. Now, I've been looking at VectorVest long enough to know that when I look at a relative safety of 1.48, and then I look at a comfort index of 1.71 on a 0 to 2 scale, that's what West Pharmaceuticals has. Okay, when I see that, I already know, before even going to the graph, what that picture is going to look like. Right? Again, I've been staring at it 8 hours a day for 14 years, so I know that price pattern is going to have that northeasterly direction, right? Lower left to upper right. Earnings. Now I have a 5-year graph up here because it's the longer term, that we like to focus on here. But this is a 5-year graph. If you looked at a 3-year or 1 year, it would have, a little more dramatic moves, but it's the same pattern. Earnings per share is rising. Consistent, predictable financial performance will drive the stock higher. Okay, that's a 5-year graph. Now, I mentioned that a safe stock doesn't have to pay a dividend, but if it does, it better grow it. And so on this slide, I added the dividend, and you can see the growth as that dividend continues to grow each year. As it turns out, West Pharmaceuticals is one of the stocks that has grown its dividend, not only paid, but grown the dividend every year for at least 25 years. Okay. What they call an aristocrat. Now, it wasn't in the S&P 500 for a long time, so it won't be found on that list. But it is a 25 plus company that's not only paid but grown their dividends. So I love this stock, and I know that high RS, high CI stocks are going to look just like that. Right? They're going to have that history to them. A lot of folks will often ask, why are they called ruler stocks? So I added this. They're called ruler stocks because the old saying, or the old adage was, you can track their price movement, whether it's price or earnings, and have that straight line, right, where you can draw that straight upward line. Again, I know nothing goes straight up, but you get the idea of how the name might have come along. So those are ruler stocks, just a great way to find high relative safety stocks in the VectorVest program. There are other ways as well, but I focus on that one because it's just frankly my favorite. I have a portfolio here that we use in what we call our retirement coaching group. It's one of our model portfolios where we build and manage this portfolio. I also took this shot earlier today. This is a portfolio that began on January the 3rd of 2017. It is now just finishing out its fourth year. That's right. So it's just about 4 years that it's been in play. We know that we had the our confirmed down call came. We had a big sell off. We just actually today, because we got a confirmed up call yesterday, confirmed at the close of trading yesterday, and we just added new stocks in today. We did have some positions going into today, but the point is, over a 4 year span, what we have here is 116% return on our investment, or gain, I should say. It was up nicely today. That it was a $100,000 portfolio that began. It is now up over 28% on an annualized rate of return. Okay. Now I'm going to talk about these drawdowns that you see. I've said 5 times already, nothing goes straight up. We do have these roadblocks that we run into, and I'll talk about how to mitigate that too in a minute. Okay, 28% annualized rate of return. Most people, first thing you'll ask, well, or what most hedge fund managers or mutual fund managers will say, well, how did it perform versus the market? Because that's their bellwether, right? Can they beat the S&P 500? Which, there's a lot of reasons and a lot of rules behind what they have to do. But I say, of course we can. Right? Of course we can. In the most prudent, conservative portfolios, I can. Forget about being a little more aggressive. So I run a quick test, and I run it against the SPX, or the S&P 500. You can use the SPY ETF if you'd like. It's up 50. Well, listen, it's up nicely, right? And again, I'm going to call it 4 years at this point. 3 years and 11 and a half months. Uh, or yeah, 10 and a half months. I'm sorry. 58%, 15% annualized rate of return. Well, with a very basic risk management technique, an investment plan and process behind it, you can see these flat lines that got us out in the worst times in the market. We were in cash, and then we rebuild with the same good quality stocks, and we've doubled the performance of the S&P 500 with really the most basic strategy you can. And James has asked, we just use confirmed calls. James, that's all we do. There's a little more to it. There's a strategy behind it, but these are the returns. Again, with a prudent/conservative trading plan in mind, you're able to do pretty darn good. And anybody who doesn't think 28%, and maybe it's more around 21 or 22 if you do a compounded rate of return, if you don't think that's like really good, then you maybe should give me a call. We need to talk. Okay, so I'm going to take a sip of water, but I'm going to ask you guys to interact with me. I know the answer, but I want you to just be involved here. Portfolio roller coaster. Would you rather have no safety or not take safety into account? Or would you rather work towards a portfolio that has that safe, steady climb like we find with stocks like West Pharmaceutical? I'm going to ask you to type in because I need a sip of water. Yeah, and everyone's typing in, of course. Yeah, I know the answer, but I want you to stay with me. Yeah, steady climb. You want to take that ladder, that safe, steady climb, and we want to do that. James asked, must Profit Locker Pro be used or some other stop loss? James, I can tell you very quickly because it's a good question. I don't want to just brush over it. This uses the Profit Locker Pro, but you can any conservative/prudent stop criteria, 50 gain, 15 loss, rec equals sell, 15% trailing stop, are going to perform okay, pretty good, real good. But again, the best returns come profit like a pro. But the point is, a good prudent risk management plan will get you very good returns. But it's a good question. I didn't want to just go over it. Clayton says, do you always wait for a confirmed uptrend? Clayton, for this particular strategy, yes, we do. Does that mean if the market really bottoms out, I know because I know this is the process that the thought process people have. Do I have to wait? Right, the market's going to keep moving up, and I'm missing that move. Well, the short answer is this. Well, two answers I have for that, because that is also a good question. Answer number one: what you could do if the market's coming off a bottom and it's starting to move its way up, all of a sudden the primary trend is up, there's a green light in the price column of the color guard, maybe a DEW goes up. Can you begin to step in and buy one or two stocks at a time? You certainly can. But let me just give you this caveat. I I sit and back test different strategies with different stop criterias a lot to try to put together the most prudent, conservative, the best trading plan. And I can tell you every time I try to use a green light buyer or DEW, over time, they do not perform as well as this. Shorter term, they might. Right, if I use the May 18th, we had a confirmed up call, and the market has been up nicely since, right? So if you had started much earlier on our more aggressive timing signals, you would have performed better right here. Right? But when you do it over a period of time, it doesn't work as well. The beauty is if you have VectorVest, you can go and test and play with that all you want. And it was not just a buy and hold. The system okay, these are good questions. Get caught up, and I'm not going to make it through in time. You can see these flat lines mean that we got out of we were in cash during these flat lines. Okay. You could just buy and hold and you'd probably have a good return. But what's going to happen is you're going to have huge drawdown. In the real world, it's hard enough to live through this. You start making that huge drawdown and you've got to convince yourself that I'm staying in this, right? When you have a huge move to the downside, for the sake of math, I'll use 50%. You lose 50% of your portfolio, right? Your portfolio now has to double just to get back to even. That's why we never just buy and hold, set it and forget it. You've got to have a plan in place. Otherwise, the time use of your money gets wasted and your net worth will diminish, and that's not what we want. Okay. I'll get off that soapbox. Capital appreciation. Next is income. Let's talk about income. We shift gears here fairly dramatically, right? Our goal here was to generate a capital appreciation, buying good quality, safe stocks in a rising market. When we talk about the provide side, we're talking about a steady income flow. And there are two parts, from dividends, and I'm going to talk about covered calls. So part one is about dividends. So let's talk about how to build a good, safe dividend growth portfolio. That's kind of the foundation behind it. Okay, so our goal here, of course, is different than the capital or the provide side or the capital appreciation. I'm sorry, the profit side. Our goal is not, listen, we want capital appreciation. We want our stocks to go up, but it's not our main objective. Our main objective is to get paid a safe, steady income. Now, how do you find good dividend stocks? Well, you can Google good dividend stocks, and you're going to get, I'll tell you exactly what you get. Oh, this is probably a little bit older, but probably even more than that now. 850,000 results. And what most of them are going to do is give you stocks and sort them by the current dividend yield, as if that was the indicator that told you they were the best dividend stocks. And it's not. And in fact, it's very much not the indicator we want to use. There's other, websites you can go to, and you can see again down here, current yield 32% on a $4 stock. Okay. I mean, I don't know. I guess I don't know much about it, this particular one, but it's not the type of numbers I'm going to build my retirement dividend growth portfolio from. See, same thing here. Dividend yield is how they're sorted. We don't want to do that. I don't know what it is now. 3 or 4 years ago, I did a special presentation, created this strategy that we call blue chip dividend payers. And I made it as basic as I possibly could. So it's open to being tweaked or changed at all. But All I said was I want to build a list of stocks to choose from the Dow Industrials, Transports, Utilities, and the S&P 500. The stock in question has to have at least a 3% dividend yield, and it has to come from one of these two watch lists, DRIP 1024 or DRIP 25 plus. DRIP simply means dividend reinvestment plan, and 10 to 24 means that's how many years that any company on this list has not only paid but grown their dividends. And then, of course, the 25 plus. And then finally, the dividend safety that I talked briefly about earlier has to be greater than 50. That assures us a fair or a reasonable or favorable dividend payout ratio. Meaning that, am I buying a company? Some of those other companies, if you look deeper, what you'll probably find is that they're paying a higher dividend than their earnings per share. Right? In other words, their dividend yield is greater than their earnings yield. I don't know how you keep up with that. I don't know how you continue to pay that dividend. So uh, this is what we look for, and these are the type of stocks that come to the top of the list. Remember, I said when we went from capital appreciation to income through dividends, we shifted gears. And the first thing I hope that you notice is that the relative safety is not very strong on these. It doesn't have to be for a good quality dividend payer. Um, these are more mature uh, companies. They have strong free cash flow that allows them to pay these dividends and pay them safely. Right? And you can see that by even though relative safety is not very strong, relative value is strong here, and their earnings growth rate and their dividend growth rate, okay, are both very strong. Okay, and the dividend safety would certainly be above all of these. Okay, would be above 50 on all of them. I'm sorry, it's cut out here, but it has to be above 50. Okay. So again, in our Tuesday coaching session, we have a lot of these stocks in our current portfolio. One of my favorite, another one of my favorite stocks from a great search here, I think, is T. Rowe Price. Right, I actually own the stock as well. This is what, again, we talk when we talk about dividends. Now I have a 25. Right, in VectorVest, you can go all the way back 25 years. We've got this footprint here. What I like to call, you can see the growth of this stock's dividends every single year. What I like to call the golden staircase. Okay. I didn't put earnings per share on this, but trust me, earnings per share has got a nice steady rise, just like West Pharmaceuticals had. And this is a 25-year look. This is a weekly graph, 25 years. Okay. You can almost tell the dates just from looking at the drawdowns. Right. This was 2008. This was in 2018, both January and October were very rough, and then again this February. Okay, so that's the picture of what a good quality dividend growth stock is. Okay. All right. Now, I also have, for our Tuesday session, we have a portfolio, a dividend growth portfolio. So just to give you an example, when you follow a good quality strategy and risk management techniques, you'll see that this is a portfolio. Now, this is older. This goes back to January of 2013. We use it in our coaching group. It began as a 5 year, and then it just continued the portfolio. Yes, we have drawdown. I'll talk about how to mitigate that in a moment. But here, and again, we'll call this 8 years. It's just finishing its 8th year, I guess you'd say. It's up 133%. That's just the capital appreciation. Okay, just the capital appreciation. That doesn't include the dividends. That comes to about, I'm just going to call it a 17% annualized rate of return. What this doesn't include, and this is a low ball figure because I did calculate these numbers for the life of this portfolio up till about 2 years ago, where checking every position, every week, it got to be a bit cumbersome. I thought I proved my point. I'd calculated to about $33,800 every position that we held for the dividends we were entitled to. So now I'm lowballing it at about 35,000. It may be even more. This number doesn't include that. So when you add 35 grand to this 133,000 that we're up, right? With some basic math, and I know there's some nuances there, but they're working in my favor, because if I just add 35 grand, that's 168% return. When we do that, that annualized rate of return is just over 21.25%. And the great thing about this is that doesn't even include reinvesting the dividends, the power of compounding and reinvesting those dividends. So that number would be even higher. Again, we'll compare it to the bellwether over the last, I'll call it 8 years. 143%, 18% return on the S&P 500. That's great, but we're actually outdoing that. We're outdoing that number, certainly on the capital appreciation side. And again, it doesn't even count uh, uh, reinvesting the dividends, which would grow that exponentially. I call it, just jokingly, or admiringly, I guess, lovingly, a very boring portfolio. Right? There's again a very conservative management technique, and we just sit back and we collect those. Can it get hit? Sure, but it just continues to grow. All right, let me continue through, because the next income portion is going to be part two. And I'm going to spend a few minutes, and I want to talk about generating income in a retirement portfolio using covered calls. If there's anyone in the chat room who is not familiar with options at all, or covered calls at all, or protective puts that I'm going to talk about in a minute, don't worry. Don't, push back from your desk or whatever, or shut off the computer. You do not have to be an options expert to do what I'm about to show you on covered calls, and you do not need to be an option guru to understand how to identify when and how to buy a protective put. Because I know you all have an insurance policy of some sort in your life, on your home, on your car. That's all we're going to do here is talk about buying insurance policies. First, I'm going to talk about covered calls. So look at it this way. It's like charging rent to the stocks that reside in your portfolio. Right? It's like charging rent to the stocks in your portfolio. One of the best definitions or explanations comes from a gentleman named Lee Lowell. He wrote a book called Get Rich with Options, and it's just a very logical, straightforward definition of what it is and why you should understand how to do it. I won't read the whole thing, but he says there are other traders out there who will give you money today for the right to take your stock away from you if it reaches a much higher price. Selling covered calls is such a great strategy for padding your bank account. I can't believe there are investors who aren't taking advantage of it. And frankly, neither can I. Okay. Someone's going to pay you today to take your stock away at a higher price. Here's a quick description. There are two types, I guess, of covered calls. One is called a buy right, when you buy the stock and sell the covered call simultaneously. So writing a contract or selling a contract is synonymous here. So it's called a buy right. It's the simultaneous purchase of an underlying equity and the sale of a call of the same security. Okay, remember real quick, when you buy a call option, if the buyer of a call option has the right to buy 100 shares of stock at a certain price by a certain date. Right? He's not obligated to do anything. His goal, of course, is that the value of the underlying stock rises so that the value of his call option rises. Now, as the seller of the call option, we get paid. Right? But we never get paid for nothing, right? So you get paid, but you're obligated to provide that stock. So if the stock goes way up, right, you have to provide that stock to the call buyer. But the great thing is you already own it. It's not like you got to go out in the open market and buy it, hence the name covered call. You're covered by the fact you already own the stock. Great way to generate income. I'm going to show you in a minute. You can also sell one option contract against every 100 shares of stock that you already own. It is the most common, the most used option income trade that there is. And it's also the easiest one. So let me walk you through again, just quickly. I can do an hour just on covered calls, but I want to illustrate this for you. So let's say you either own or you buy 100 shares of a stock. In this case, Dollar General, and don't worry about the time frame or the price of the stock. It's the idea I want you to take away here. So you go out and you buy Dollar General at $112 per share. I simultaneously go out, or maybe I already own the stock at 112. That's where it's trading. I go out and I sell a call option, right, with what's called a strike price of $115. Right? That's the price at which the buyer of the call has the right to take my stock away at $115. Right? He's going to pay me $2.65 a share, or for one contract, 265 bucks. He paid me to take my stock away at a higher price at a later date. And I said, fine, pay me. A couple of what ifs. What could happen? Well, if the stock goes down, the profits from the call you sold will help minimize the losses on your stock. Right? Remember, you lower. I own the stock at 112. I sell a call option at $2.65. It really means I own the stock now at 109. What would it be? 109.35. If I'm doing that math right. 112 minus 265. 109.35 is really where I own the stock now. So the stock could go down and I actually have a cushion. Now, if the stock goes below 109.35, yes, I will begin to incur losses. Those losses come from the fact that I own the stock. Okay, but we have plans in place to, of course, manage that. Now, what if the stock goes sideways? You make profits on the call you sold, get to keep that premium. Plus, you can always sell another covered call since you still own the stock. And then finally, if it goes up, you make your max profits. The stock, what they call called away, right? The buyer of the call option has the right to call away your stock, right? But you get to keep the premium and you get to keep that capital appreciation, or the difference between the strike price and the purchase price of the stock. So what would have happened? At expiration of this particular trade, Dollar General actually went up to 119. I would have gotten to keep $300. That's 112 to 115. That's the capital appreciation, plus the $265 in premium that I was paid. So that's $565 that I made on the trade. And yes, before you type it in, I know the stock went up. And if you kept it, you might have made more money. But the stock, I don't know where the stock went after that, but it could have gone down, it could have gone up. It doesn't matter. Your objective on the trade was to generate income, not capital appreciation, well, a little bit of capital appreciation. You weren't buying this because you thought Dollar General was going to go to 180 in 2 weeks. Whenever you hit the enter button to place a trade, you must know what your objective of that trade is. In this case, the objective was to capture as much of that 565 bucks as I could. I knew going into the trade exactly what my max profit could be. I want to capture as much of that as my process will allow me to. So here's a quick example. I'm going to click through this fairly quickly, but you can go in. Again, in our Tuesday sessions, we have a weekly trade that we do. This began in June of 2019. June of 2019. Just going to walk through some quick trades. I'm not going to break them down too much here, but we bought 300 shares of AMD using a process that we use in our coaching group. And then we sold 3 covered calls. We closed that trade a month later and took in $603. That's 6.81% in 31 days. Imagine if you had a stock that paid you 6.8% a month, let alone an annual dividend rate. 6.81% in 30 days. We did the trade again using our process. We bought 300 shares. We sold 3 calls. We were able to capture 600 bucks. That's 7.4% in 28 days. Our process had us with a couple of other stocks in the portfolio, but got us back into AMD on November 5th. 4%, 28 days. I'm going to click through this fairly quickly here. Okay. Another 5% in just 10 days on this one because it met our profit target. And then we had opened another one when I created this slide, and I kind of jokingly said, we're not sure where it's going to end up. But at that point, we're already up 375. So then I just add to the slide that on February 18th, in fact, that should read 2020, sorry, on 2/18 of 20, we closed this particular AMD position for $538 profit. What a great way to continue to generate a safe, steady income. So that's dividends and covered calls for that core strategy of a safe and steady income. Let me go ahead and finish up with capital preservation. Capital preservation, the most important part of managing your portfolio. Let's talk about protective puts first. And this is where the quote comes from Mark Twain, where it becomes so applicable here. Don't just sit there and worry, be proactive. Do something. Okay, do something. So, what are we going to do? Well, we know that our goal here in protective puts and insurance is to protect our assets. Right? That's our goal here. So to reduce that risk, what we do is we go out and we buy put options to protect individual stock positions, or you can buy puts that will help you protect your entire portfolio. You can also use option collar trades, which is a combination of a covered call and a protective put, but I'm going to focus just right now on buying a put option to do that. Insure yourself. Okay. I know that you all have car insurance, life insurance, homeowners insurance, health insurance, whatever. Heck, my wife and I have insurance on our 2 dogs. You insure your assets. Why not understand and implement insurance policy on your retirement portfolio? Okay, so we're going to focus on a trade called the put option. Right? There may be folks in the room. That's the hard thing about doing it. I don't know who has any type of option knowledge, who might not. So I'm going to explain it as if you don't have any option knowledge. Okay, but we're going to talk about a put option. Okay, before I get into the case study on Texas Instruments, let me just set the scenario here. You own Texas Instruments, right? You own the stock in your portfolio. Good quality stock. You bought it on a confirmed up, either here, heck, maybe you got it way down here. But you really want to be defensive, right? You're worried about the stock. Listen, you could always sell it before anyone types that in. You could always sell a stock. But we do our due diligence, and we have to recognize those strategic times to protect our positions. So what can I do here? If I'm, for whatever reason, and I'll talk about reasons in a minute, I could go out and I could buy a put option. Now that insurance policy or that put option, same thing, depends on where you set your strike price. So I own the stock right just under $100. It's trading at 120. If I do an at the money put option, it's going to cost me a little bit more money to do that trade. But I don't care. It's just like buying an insurance policy with no deductible. I could just as easily go out and say protect my stock that I own at 120 to anything down below 115, so I will have some deductible there. That's kind of how the idea works. Let me just say a put option for those who aren't familiar. The owner of a put option, right? If I buy a Texas Instruments 120 put option, what that means is I have the right for one contract to sell 100 shares of Texas Instruments at $120. Right? I bought that right. That's my insurance policy. Okay, let's jump into the case study. So here's what happens. You bought it here again, don't worry about the dates, 11/24, because we got it confirmed up and it's a good high RS stock. That stock went from, again, roughly what, we'll call it $100, just under 100, all the way up to 120 because it did exactly what we thought and wanted it to do. On January 17th, we have a gain of $2,000, 20%. Here's the mindset you have to have. I don't own this stock any longer at $100. I own it at 120. Okay. I know my cost basis is down here, but it's not the mindset I want you to have. You own the stock here. It's incumbent upon you to protect your unrealized gain. Because you do your due diligence on every stock you own, 1 week prior to earnings, you want to be able to protect your gains. You could sell it. You want to rebalance 10 or 12 or 15 stocks every 90 days because earnings are coming out. You can do that. I don't recommend it, but you certainly can. Or you can be prudent and buy a put option. The 120 put in this scenario would have cost $4.23 per share, or $423 to protect what was at that time a $12,000 asset for just 100 shares. Maybe you own 500 shares, I don't know. But for 100 shares, you're protecting a $12,000 asset for 423 bucks. It's the cost of doing business, it's the cost of protecting your net worth. What happened? Well, Texas Instruments had an announcement and the stock gapped down. Even the best stocks can have a bad earnings announcement or guidance or whatever it might have been, but the stock gapped down. Remember, when the value of the underlying stock falls, as it did here, the value of your put option rises. Right? You get paid. You paid $423 insurance policy. The asset you were covering was damaged, and so your insurance helped pay for it. That's all it is. Here's what it looks like. Had you not bought insurance, your $2,000 gain would have been cut in half. Right? It didn't need to be. Sometimes things happen we don't know they're going to happen and we can't protect them. But in this case, you could have, right? Because you knew that earnings were coming out. Right? $1,000 gone right off the table. Had you bought insurance, as we just showed, you would have profited roughly $700 from the put option, which would have mitigated your losses only down to $1,700. Right? You only gave back $300 of that profit. And now you can keep the stock and decide, do I want to keep it? Do I want to sell it? It's a much better way than just having stop criteria on your underlying stocks. So again, you minimize your losses there. You don't have to type this one in because I want to go into an overall market case study, but I know the answer. Would you rather understand and know how to insure your nest egg, insure your portfolio, or would you rather do nothing and just hope? Hope is not a strategy. It's not a process. It's good to have, I suppose. But if it's all you have, you're not going to do well. Of course, we want to buy the insurance. Another way to do this is to protect your overall portfolio. We recognize trends in the market that tell us, okay, don't just sit there and worry. Okay. All right. And I just happened to notice Ocean typed in, and I thought I just said this. What about if I sell the stock before the earnings? Yeah, go ahead. You can certainly do that. If you have 10 or 12 or 15 stocks in your retirement portfolio, earnings come every 90 days. Are you going to dump 15 stocks every quarter and then rebalance the entire portfolio 4 times a year? Listen, it may be a great hedge fund or mutual fund strategy. You can go ahead and do that. I hope you don't have a full-time job, but you can go ahead and do that. But my point is you don't have to. You don't have to. 2 clicks of the button, you purchase an insurance policy. It's the cost of doing business. Okay, case study on the entire market. When I look at the overall market, I created this slide for a presentation I was doing before the February pandemic sell-off. And I was conducting some other courses and some things were going on, and I was noticing that no one seemed to think that the market would ever go down again. This is, again, I didn't know about the pandemic, didn't know it was coming. I knew the market would go down again. I didn't know how quickly and how soon it would happen. So I was putting this portfolio together, telling folks to, don't think this is what happens all the time. You have to be prepared for when this turns. So if I stretch this graph out, I was saying, don't tell me about this unless you're going to, somewhere in that same paragraph, remind me or let me know you remember what happened here. This is October of 2018. I know in this day and age it's forever ago, right? October of 2018. Wow, 2 years ago. That's forever. It's not. We lost 20% in 90 days in the market. We did it in the beginning of January of 2018 as well. So why is it important to be able to recognize the times? We could have prevented this or mitigated it greatly by just taking note of the current market trend. Why is it so important? Because in this case, it took you over a year. Yeah, it did go above, but it pulled back, kind of hovered around that line. But it took a year to rally again. Other, just I should say, just to break even. Stock fell. Your time, use of money, had you done just sat there and done nothing, leaves you here. And these are where the big drawdowns come in our portfolios. Well, we can protect against that. So what I've done is I've zoomed in. Remember now, this is the February of this year, the pandemic sell-off that we saw, right out to March 23rd from late February. Okay, I'm going to zoom in one more time on it. How can I protect against that? Well, you can, and it's actually pretty simple. Actually, it's very simple. We have we have a lot of market timing indicators. Some are more or quicker, more aggressive, I guess you call them. The DEW, the detrended price oscillator, the envelopes, and the weighted moving average. It's an acronym for our DEW timing system. That went down on February 24th, 2020. That's a signal. That's a reason to worry. That's a reason to be proactive and do something. So what could you do? Well, you can buy put options on the SPY, which is the ETF that tracks the S&P 500. It's a great way to protect an overall portfolio. Now, just 4 days later, we got a confirm down, right? So maybe you would have waited for that. And even if you did, at that point, you should have gone out and become defensive in your portfolio. So here's what it would have looked like on the 24th. The DEW timing system went down, a good time to place a put option on the SPY to protect an overall portfolio. Now, this example is not an actual trade that was done in our Tuesday coaching sessions, though we do place trades like this all the time. But let's just theoretically say, with a signal that tells me I need to worry, and the headlines that were beginning to come in, that we were beginning to see, you could have gone out and bought one SPY April 322 put option and paid $975 for it. $975 to protect your entire portfolio. That's just one contract. Okay. Just a few weeks later, that contract would have, or that option would have been worth $71 per share. Right? That's $6,000 insurance payment towards the damaged asset that you owned. Now, I'm not saying you would have gotten out right at the bottom, right? That's why I actually circled the next up day. But it doesn't matter. I'm here to tell you you had a very clear picture of when to purchase the insurance. And if you had gotten out anywhere in this range, you would have mitigated your losses greatly. Now, real quick, I'll just show the puts for portfolio protection from the 28th, right? If you had waited, which, listen, is not the end of the world. We didn't know where it was going to go. These were pretty big moves. You could have bought one March 296 put, $14 per share. Okay, a few weeks later, that 296 put was trading at $67 per share. That one's only 5,300 return, he said sarcastically. Again, I don't, you would have gotten in somewhere in this range between the DEW and the confirmed down. Anywhere in this range you had gotten out, you would have mitigated your losses tremendously. That's how we fight against these type of drawdowns. We know high relative stocks are resilient, that they'll rebound, but we don't have to sit through this catastrophe. It doesn't have to happen. There are ways to protect them. In fact, one of our subscribers, Elaine, wrote a note. This was way back when I talked about this in January of 2018. So because of your teaching, I hedged my portfolio at the end of January of 18, right into the first week or two of February. That's when that sell-off came. He said this saved a section of my portfolio for just $835. The puts he bought were worth $23,000. That was a dramatic, very quick, very dramatic sell-off. So always good to see those kind of letters that come in. And that, again, once again, is the shot of what happened there. These are huge moves in the VectorVest composite. From 285 all the way down, trading as low as 250, but hovering in that 260 level. It's a huge move. and we had a signal and a reason to be proactive. So this is what we talked about: capital appreciation, generating income, part one and part two, and capital preservation. So just a quick review: we talked about growth portfolio. This is what can happen when you find good quality, high relative safety stocks and have a prudent risk management technique behind it. I showed you the blue chip dividend portfolio. I talked about the power of the dividends that come in, even though this number doesn't reflect them. I added them up, or lowballed the add up number, gives us 168% and still outdoes the S&P 500 pretty nicely without a whole lot of work to do here. So a great way to build the safe dividend growth portfolio and outperform the market, certainly. Then I talked about our income with covered calls. And this is just from June of 2016 to February. I can show you again. This is a spreadsheet from our retirement coaching group, and that was in 2019. We got one here. It's the resolution. I could do it this way. You have a trade right here where we made 538. Few weeks later, we did another 894. This is all just AMD. Another 616. We did again 1100, and then we had one more down here. These are in addition to the ones I showed you, another 1170, and then we currently have one that's open that is profited around 600, just under $600 right now. Okay, one trade a week, doing a covered call. We're up over 80% winning trades, 20% return. That's the power of that. And then I talked about Texas Instruments, and I talked about the power of protecting your port. These are just the same slides I just showed you. Okay. So the obvious question that I have for you at this point is, how can you implement the system right now to get results as quickly as possible, to be able to be prepared for that next black swan, if you want to call it that? Right? How can I implement the three core strategies that we talked about? Well, it's time to make a choice. You can do this alone. That could take a while. Plus, when you keep doing what you're already doing, you'll end up seeing the same results. So if you're not happy with those, you can do it by trial and error. But you'll keep making the same mistakes, which could lead to, again, damaging your assets. Right? How do you protect your assets? It's a little couple of keep banging your hand with the hammer, run out of fingers. Instead of going through that maze, you can do it fast. Use a system that's been proven to work, so that you can bypass this trial and error thing that you don't have to go through, these catastrophes you don't have to go. Right? And that's why, towards that end, that's why we've put together the Ultimate Retirement Solution online course. It's designed to protect and grow your retirement nest egg. Okay? It's designed to take you by the hand, guide you through the method that you need to grow and protect your net worth and give you that peace of mind in retirement. I'd like to take just a second to walk through the 6 modules. These modules are located in the VectorVest University, and you will have access to the 6 recorded modules, and there's a whole lot more that goes with it. So be patient, stay with me. Let me just walk through the modules that we teach. Win before you begin. This is where you get a clear idea of your objectives. It sounds, I don't even know what you want to call it, silly, but you have to sit down. To get a pen and a paper out, and you have to write down a vision statement. You have to have goals, objectives. Otherwise, everything else is going to be run roughshod over because you don't really know what you're looking to achieve. So you'll set goals, develop management style, and learn the 3 objectives of the portfolio. In Module 2, we'll step right into building that capital appreciation or the growth portfolio. Exactly how to find the right stocks, balancing your portfolio so that you're not overinvested in any one industry or sector or stock, and set up the plan behind those results that I showed you. So that's module number 2. Module number 3 is very similar, but it does, well, and similar in some ways, very different in some. So we change gears. Now we're going to build our dividend growth portfolio. Okay, every bit of income matters as you approach or end up in retirement. Dividends are something every retiree should take advantage of. Okay, You're going to learn in this module what makes a quality dividend stock, how to find them, and how to set the right stops and how to manage that portfolio. Modules 4 and 5, these are great. I'll talk about both of these here because this is where we introduce the covered call. And I'll walk through exactly the anatomy of the covered call, how we do it, how you can do it on stocks you already own, or how you can generate income using the buy right that I illustrated using AMD. Like I said, I have a position open right now on AMD that's up about 600 bucks. And I'll show you exactly how to do it. You don't have to be an options expert. I use as little option terminology as I can. I could use all of the jargon if I wanted to, but I choose not to keep it simple and straightforward. Then, you guys, hopefully, I think some of you, I'm sure, remember the strategic defense initiatives of the early 80s, right? Star Wars. We want to do the same thing. We want to be prepared, strategically defend our portfolio. In other words, buy insurance. I'm going to walk through all of, in full detail, what I showed quickly on those slides on how to protect your portfolio. And then finally, in Module 6, we'll talk about implementing the plan. We'll talk more about allocating funds, portfolio automation, and then from Module 4 in the covered calls, we'll actually walk through a very specific, what we call the retirement income portfolio plan. It's one trade a week. I call it the RIP portfolio, Retire in Peace. It's really the retirement income portfolio, but that's what I like to call it. Right? And we'll go into the specifics of the trading plan to do that. Okay, so that is the Ultimate Retirement Solution course. These modules are archived in the university at VectorVest.com, but there's a lot more that goes with the course. So let me run through that as well. Not only will you get those six modules, but and I'll give the dates in a minute, but every Monday at noon Eastern Time, we will have a mastery support session for each module. We'll help you implement what you learn, look at what you're doing, specific trades or things, situations you might be in. If you can't make the live session, don't worry. We have a dedicated email bin. You can submit questions there. Or later that day, we archive the mastery session. So it's not like you got to wait a week to watch it. We'll have it posted for you later on that afternoon or early evening. So those are the mastery support sessions. We get to talk live in the current market about what you learned in the module. My favorite part of what I do here is the Tuesday coaching session. I've mentioned a couple of times our retirement coaching group. It's a separate entity from the URS course, but you're invited during the life of the course for the 6 weeks to join me and John every Tuesday at 2 o'clock Eastern Time. We talk about our retirement portfolios, building and managing them. We look at individual stocks, our earnings coming out. What's the market trend? Do we need to be protective? Right? Where are our stops? And we analyze those different things in our portfolios. And then, as I just showed you, this spreadsheet is from our weekly trades that we do. We have, again, 80% winning trades. We've used about $50,000 and we're up over 10 grand in this particular portfolio. If I hit the profit there, you'll see we're up over $10,000. These are actual round trip trades that we've done. And these highlighted in green are open trades right now. Yesterday we did Lennar, the home builder. We're up a few hundred already on that. NetEase, another one we're up on. These are our open trades. We'll fill in the spreadsheet when we're done. So that's what we do in the coaching groups, and you guys will be invited for the 6 weeks that the course goes on. Now, if you do trade options, or if you want to expand your option knowledge, there's a great bonus module called Trading Spreads for Monthly Income. They're called credit spreads, where you're actually selling an option, but you're doing it the right way with a lot less risk than most people will do it. Our colleague and friend, Mr. Ron Wheeler, nobody better at teaching this kind of trade in the process. So if you want to open another income stream, you can join Ron for that bonus module for high probability trades to generate income. If you're in the room and you're new to VectorVest, we're going to give you 60 days to use VectorVest. Okay, it's the best tool to determine market direction, find stocks. If you are not a subscriber, we'll give you 60 days to get through the course. And I believe you'll end up wanting to be a subscriber by the time that's over. Total value of all that, $24. You get the retirement training course. You get access to it, by the way, for 1 full year. You get access to all of the archived information for 1 full year. Live support sessions, If you're not a subscriber, you'll get the software, you get your trade spreads for income, and you're invited to the retirement coaching group. We value that somewhere around 2,500 bucks. However, if you order before the end of this, actually, this special price will be up there for a couple of hours tonight. So if we finish up and you're debating whether or not you want to, I hope that you join the course. It's let me finish. It's risk free. It's a money back guarantee if you do decide. But if you order before the webinar, right? Our what's called our the course is 795. We have what's called an early bird special of 595. But because you guys were kind enough to take the time, we're going to save you another 100 bucks, and it's $495 for all of those resources that you have access to for one full year. 6 mastery sessions, 6 modules, 6 retirement coaching group. Plus, there are resource videos within, and I'll show you in just a minute inside the university at VectorVest.com. So if you go to VectorVest.com/URS that John has just typed into the chat box, and I'll click there and show you in just a second, you will get access to this price, and it'll be up there for a little while. You know, you have to do it this evening if you want to take advantage of the 495. I said earlier, it's a risk-free trade, right? They say there's no such thing as a risk-free trade in the market, and it's true, except for this one, right? Because after the course is over, if you show you've done the work, right, and you're still not satisfied, then we will gladly give you a refund. Right? We'll give you your 495 bucks back. So it's a risk-free trade. 495. You can get that with one AMD trade and have enough left over to go out to dinner on just one AMD trade. So go to vectorvest.com/URS. How much is it costing you not to do this? If you're here to learn how the 3 core strategies to build and manage your portfolio, what I can ask you, but you should ask yourself, what will it cost you to do nothing? How much money might you lose? How much potential profit do you miss out on? How much time and energy will you spend trying to do this on your own? And then ask yourself, might life be different if I do this and it works? Right? It's never too late. The old saying is, what's the best time to plant an oak tree? Is 20 years ago, so that you can enjoy the shade today. What's the next best time? Well, the old cliche says it's today. It's never too late to prepare yourself, build and manage your retirement portfolio. Again, just $495. Go to vectorvest.com/URS. And then I'll give you quickly, because I know folks always ask, when are the live mastery sessions? Well, they're going to start on November the 23rd, and they're every Monday moving forward. And then start the new year off right, taking the bonus module with Ron, and that will be Monday, January 4th, will be the bonus module. All of these are at noon Eastern Time. All of them are recorded and archived in the university. Okay, $495, can't beat the price, and it is a money back guarantee. Okay. All right, I think I'll do this. Sorry, I'm looking at the box here. I want to do this very quickly. Okay. What I'm going to do now is ask my friend John to come in, see if there's any questions. Again, if you have a question, I know John's been feverishly answering many of these questions in the background, but if there's something you still have a question about, go ahead and maybe type it in again now so I can see it come up. But we'll answer any and all questions on what we've talked about tonight or on the course, and and I'll let John come in. Well, John, should I go ahead and do this first? If I click on the VectorVest.com URS link that John put in, or if you type it in, this is what's going to come up for you. It's the Ultimate Retirement Solution course. Enroll today, $495. Right, the regular price is $995. I think I said $795 earlier. And look, we'll even have a pop-up somebody live here to help you, but I can help you for now. $495. Okay. That price will be good for probably a couple hours after we're done here. Just simply click purchase the course now, if, by the way, I clicked it too quick. If you scroll down, it'll give you the overview of the course. You'll come to this page, your VectorVest order, save 500 bucks. Go ahead and click proceed to checkout. Now, if you are already a subscriber to VectorVest, just go ahead underneath the submit button. You'll see already a member, then just sign in. If you are new to VectorVest, we need you just to fill out some basic information, hit submit, and it'll walk you through the process to get everything ready, and you'll receive an instructional email telling you exactly what to do. And that'll happen if you're already a member as well. Once you sign up for the course, you'll get an email with all the instructions you need. Okay? So if you're new, sign that in. Ultimately, if you sign in here and you're already a member, here's where it's going to bring you. Takes a second. And so there's my VectorVest order, and I would just follow the prompts, and that's how I sign up for the course. So we make it as easy as possible. I strongly urge you to take advantage of the $4.95. I think you will not regret doing that. Okay, I'm going to ask John to see if there's anything I missed or any questions that he sees or hasn't been able to answer, and we'll go ahead and take as much time as you guys need. How you doing, John?
Sure. I'm good. Good, Jim. How you doing?
Um, I'm losing my voice, but I'm doing okay.
First question I have here is from Anthony. Pretty typical question, and that's with regards to whether the content will apply to other countries. For him in particular, he's in Canada.
hmm yeah, Anthony, good question. We get that question often, and I have I think, a pretty specific answer, and it's this. Many of the concepts transfer to all of the countries that our program reaches out to. When it comes to finding safe stocks, we analyze them all the same. Building a growth portfolio, building a dividend portfolio, all of those factors are important, and so they do translate throughout the country, throughout the world. Now, and you commented, Anthony. I see your post here. Here's the what I want to call it, the caveat or maybe the exception. You're right. The In Canada, the UK, Australia, wherever it might be, the options market is not always as liquid as it is in the US market. But remember, this really it isn't about trading options. Okay, if you own good quality safe stocks in Canada, right? Um, you you're more than likely able to buy a protective put or sell a covered call. The difference is there just aren't as many candidates. The way it translates from our program for what we do is that we are looking for the well-known companies, the bigger companies, safer companies. But you're right. The option markets are not as liquid, and so sometimes it becomes a little more difficult to apply the option part of this. So that is my answer to you.
Okay, question we have here. How much time do we will they typically have to um, commit to learning the content on a week by week basis?
Yeah, that's another question we get a lot. And listen, you're going to get out of it what you put into it. But part of me, I used to say this. Here's what I used to say. This is so easy. You put 5 minutes in a week and everything's going to be perfect, right? I don't say that. I don't like to say that. Do you need to put hours a week in? No. To build and manage and learn how to uh, manage your retirement portfolio. Now, in the first 6 weeks, if you watch the module, it's usually about an hour long. Our mastery session is about an hour long. Okay. And then if you decide, and hopefully you will, because I think it's the best part of the whole thing, is coming to the Tuesday coaching group. That's about an hour and 15 minutes. Okay. So technically, in the first 6 weeks, you're going to put in hopefully at least 3 hours a week. Okay. Now, is that too much? Is it not enough? I don't think it's too much, but you know, I don't want to be the guy on the other end here who says, click a button and everything's perfect and you never have to, do anything. Because I'd be lying to you and I don't do that. However, having said that, the the first 6 weeks are very instructive and educational. If you put the time in to do that, once you're done with the course, you'll find that it doesn't take all that much time to implement the strategies that we use. You got to put a few minutes in. You got to check your portfolio, check, the market conditions, check for earnings reports and things like that. Place one trade a week. It's not like you're day trading sitting here in front of your computer 6 hours a day looking at 2 minute bars on a chart. So that's it's about the most honest answer I can give to that. You got to put some time into it. Okay. Hopefully that wasn't too blunt.
Okay, next question here is from Richard. With regards to ETFs, any coverage of ETFs in the course?
Yeah, that's a good question, Richard. Whoops. Actually, in the modules themselves, there's not a lot that we go into ETFs. However, when we get into the mastery sessions, you know, I I I like to go into some other things, and that's the beauty of doing it live. I happen to think there is a place for ETFs in managing our retirement portfolio, but the short answer is no. The current one does not go deeply into ETFs, how to use them in your retirement portfolio. I am looking to build on that as we move forward and add more about that. But right now, it's mostly dividend stocks, growth stocks, and mostly the ETF we talk about is the SPY, right? And really that's about it. Okay. I'm going to give Gordon a tidbit here, John, while you look at the next question. Gordon
All
asks,
right.
I have a $100,000 portfolio. How many options on the SPY do I need to protect it? What can any, let's see. What did the SPY close at today? 356, let's call it. The SPY closed, Gordon, I hope you're listening to this. $356 was the price of the SPX today, or SPY. Okay. If I buy one contract, right, 356, that's 100 shares I control. If I buy one put contract, that's 300, I'm sorry, $35,600 theoretically. That's how much money I can make. If the SPY goes to zero, right, less the amount of premium I pay to buy the option. So all you have to do for a $100,000 portfolio, I can tell you right out of the gate, you need at least three, right? Less the premium you'll end up paying. Theoretically, if, and believe me, we have bigger trouble if the SPY goes to zero than 100 grand. But let's say it does, you you will break even, or you'll actually make a couple of bucks. That's the quick, easy math that we use. Now on our Tuesday group coaching, we put a few more nuances into that, but that just gives you an idea, kind of where to start when we talk about it. That's a quick tidbit.
Jim, just to clarify, which are the live sessions and which are the pre-recorded
Sure.
sessions?
Yeah. Let's see. I might have gone through that a little quickly. So these are the recorded sessions. These are the what we call when you hear me say module, that means that's the learning session, right? This is where this first module is a good overview about building objectives and vision statements. Then here, this is a recorded session walking you through step by step all the important factors in building a growth portfolio, a dividend portfolio, and so on. Okay, these are the recorded sessions archived in the VectorVest University. These dates here, I know I'm scrolling through that fast. These dates here are the live sessions. These are during the day while the market is open. You can ask any and all questions. We stay as long as we have to answer everything that we can. I'll review the module. These days, I do not teach the module. I review it and answer questions. So let's just say it's module number 2, and we're talking about building a growth portfolio. On this day, November 30th, Monday, I'm not going to go slide by slide and take an hour teaching you the module. I'm going to review the module with one or two slides from each key principle, and then we're going to talk about it. And that's what we do in the live mastery sessions. So it's important that you go watch the actual module, and then the mastery sessions are to implement and talk about it and ask questions about how do we apply what you just showed us. So that's how that's set up.
Excellent, Jim. I'm just looking through here. I think we're caught up on the
We got them
questions.
covered here. Great.
Yeah.
Yeah, there's still a few people in the room. What we like to do is, if you're in the room and you did sign up, go ahead and type in the chat box that I'm in. Just type in I'm in. I can tell you quickly what you will expect to happen. Um, in a little while, you'll end up getting back your an instruction email exactly how to access the course, and I can even show you that very quickly. Yeah, Ernie's commenting on something I tried to repeat as often as I could in the last hour. Ernie says, being new to trading in VectorVest, learning option becomes very difficult. Uh, Ernie, I am here. Does that mean you're in? If you're in, Bernie, great. Ernie, rather. Uh, if you're in, great. But you're going to a point that I talked about. Learning. Okay, you're in. Fantastic, Ernie. Great. I'm gonna. Here's my goal. Here's my promise to you. I will do everything I can for those who are new to options to make sure that you're not overwhelmed by how. Again, we're only going to talk about a covered call, and we're only going to talk about a protective put. There's dozens and dozens and dozens. I have a book right here in front of me called The Bible of Options Trading. It's got about 280 option strategies to it. We're not going to talk about any of those. We're going to talk about a covered call and a protective put, and I'm going to make it as simple as possible. So fantastic that you're in. I look forward to seeing you in the course. I appreciate that, John and I will do our best not to let you down. James says he's in as well. Thank you, James. Um, I hope I don't say the name wrong. Niranjana. I hope I'm saying it right, but is also in. So keep an eye out. Um, keep an eye out for the email that will give you all the instructions on how to get your access to everything involved here. And listen, if you have issues on day one here, don't worry. Our product support team will get you signed up. Um, we'll get you. You give us a call. We'll make sure that you get the pricing that I've talked about and that you get properly set up. Okay. So don't worry if the first click is, and it doesn't happen often, right? Usually this is pretty straightforward stuff. So Niran John
Jim,
says, well, I'm sorry. Go ahead.
question on the courses,
Hmm.
the course. How long do they get access to the content?
Yeah, no, that's a great question, and one of the great, I think, the great bonuses of taking the course is one, you have access for a year from the end of the course. John, correct me if I'm wrong. I think from the end of the course, you have access
Yeah.
for 1 year.
Yes.
So let me, as I'm talking here, let me show you this real quickly here. So if you go, all you're going to do to get access to this is type in, hold the screen over here, is you're going to type in university.vectorvest.com. Okay. And this is what it's going to look like when you get there. Once you're all signed in and ready to go, and you have access to this now, just not the course. So once you're signed in, as I already am, I'll hit my dashboard, and you'll see. Well, you'll see a lot of things. I just want to show you what the course looks like. Now I have them all, so don't be confused by all of this. But if I come down here, you'll see the Ultimate Retirement Solution course. Okay, so I'll just give you an idea of what it looks like. When I hit continue, here is where all of the information is for the course, and there's a ton of it. We have a welcome video, right? We have module 1, module 2, right on down the line, and what I have clicked here, say module 3, or if I click presentation, I'm sorry, for module 2, this is it right here. This is it's about an hour long, I think, a little over an hour, right? And that's me talking in the background. Okay. Then you have, well, we give you homework, and then we actually do a video to walk you through the homework assignment. Then we have our mastery session. Right now, there's probably an older mastery session in there. The day of our live one, we archive it that afternoon or early evening. It'll be in there. So this is all the stuff that we give you here. We give you a lot of help videos. You'll see all the modules. You'll see here, number 9 is the bonus modules, how to trade spreads for monthly income. And then here is where the group coaching sessions are. So you'll have access to all 6 of those. And we even have a live stream. We live streamed this course, I don't know, earlier this year, last year, whenever it was, and we videotaped it. And so it's a different way to watch it. It's I'm actually up on the screen doing the lessons, um, and we do the whole course in one day instead of 6 week modules. We do it all in one day. So you have that as well. There's resources. There is all of the slides, of course, are available to you as well. Okay, some spreadsheets for the course. For some of the modules have spreadsheets and all kinds of things for you. So I just wanted to share that with you. That's what you get in the university when you sign up. So that's what you guys can expect. Okay,
All right. I think we got it, Jim.
we got him, John. All right. Well, again, for the folks that are left, thank you for taking the time to be here and spending the time and staying with us. VectorVest.com/URS. If you got to think about it for a little while, that 495 price will stay up there for a little while after we're done here, a couple hours at least, I think. I'm not supposed to say that, but at least a couple hours. So think about it. Join us. It's risk free. We'll give your money back if you don't want to be there, as long as you show up and do some of the course. All right, folks, on behalf of John and myself, thank you so much for taking the time. Stay safe, stay healthy. I hope to see you at the course. If not, we'll see you next time. Everyone, have a great night.